Hey everyone, this is Abhishek Kumar from Ingenetus Consultants and Provitt Private Limited. Welcome to our sixth video blog. Uh, we covered types of mutual funds and the subtypes in our previous few videos. In this video, we like to take you to the taxation of mutual funds. So we'll also try and cover indexation as a concept in debt funds. What does indexation mean? How does it impact your returns? So, just to focus you towards the whiteboard, this is the taxation which we are talking about. Anything above 60% of equity is treated as equity taxation. Equity being 100%, balanced funds being 65% into equity have equity taxation. So this is the taxation. If you redeem your money, if you take out your money before 1 year, you're taxed at a flat rate of 15%. And if you keep your money for more than 1 year, then the money and everything is tax free in your hands regardless of your tax slab. So there is no capital gain in case of equity. If you keep the money for more than 1 year, before 1 year you're taxed at about 15%. So equity taxation is pretty simple. I think I'll not spend more time on this. This is the debt taxation. Debt taxation is for about 3 years for short-term and long-term capital gains. Before 3 years, the debt taxation, so if you withdraw your money before 3 years, you are taxed according to your tax slab in debt. So if the need is to withdraw money before 3 years, it's better to invest in someone's name who is not in the taxable bracket or who is in the minimum possible bracket. So let's say if you are in a 20% bracket and you get some income out of debt funds, that income is added to your tax bracket and you're taxed accordingly. Now, after 3 years, debt has a very unique proposition called indexation. So I'm not aware of how many of you are aware of this concept of indexation, but I'll try to explain this concept to you guys. So the taxation states that for when you withdraw your money after 3 years, you're taxed at 20%. Flat rate with indexation. That's what the taxation states. These are the two scenarios which I've tried to explain in indexation. There is an indexation figure which RBI declares every year. So in April, you get an indexation figure which is declared by the RBI. On an average, it's about 9 to 10% approx. So I've taken two scenarios. One is where the indexation figure is 9%, the other is when the indexation figure is 12%. Mainly indexation figure is a replication of the inflation